Hey, how you guys going? Welcome to the first live in the studio. I hope you can hear me okay. Look, if you've just dropped in and you don't know what's happening, that's okay. I'm just here to answer your questions, given that it's been pretty hellish out there in financial markets, and I'm effectively just trying to test a little bit of the technology here in the studio. So, what we're going to do, just give me a moment to get a couple of things set up. We'll be here about an hour or so. Borrowing money to buy the dip, yes or no? Whoa, whoa. Oh, look, what's your strategy, James? Had you already planned to borrow money last week and were going to invest, or are you panicking now, or not panicking, but freaking out or seeing the opportunity and like, how can I leverage up? Well, the thing is, how do we know um, when we're at the bottom of the dip? We could be halfway through the dip. So I think that's why it's important just to always have strategy first and foremost in mind. Hey, just before we kind of get going, I'm going to sprinkle this on throughout the live. It is general advice only, anything that I discuss, and get personal advice if you need it. Thanks for everyone putting their questions in the chat. So, effectively, what I'm trying to work out, and this is the first night that I've done such an endeavor, I'm planning to do a weekly live money show on a Monday night, and I just wanted to jump on and test the tech. So, let me also, so thank you for letting me check my book, The Quick Start Guide to Investing. I might reference that throughout the stream, but look, I'm just testing these underlays to be fair. All right, so what? How we're going to do it? I think when it comes to our investing, and I'm still trying to just sorry, I'm just trying to get this right set up so I can see any things that come in. Here we go. Should the RBA hold an emergency meeting and cut rates? No. So the thing with the RBA and holding an emergency meeting, the stock market, um, it reacts faster than central banks can and will and want to act. So the thing is, when the RBA sets its strategy, they don't want to shock the market. The market does that. So reserve banks really want to be, well, the Reserve Bank really wants to be very sure and measured and not be jolty. If the fact that they if they did call an emergency meeting to discuss rates, that would put a fair bit of panic and worry. And I don't even know the last time they have had an emergency meeting. A couple of things when it comes to um, the Reserve Bank, the the market is saying there will be further cuts now, and that's because there is likely that there will be a recession, a global recession, US recession, because the way that Trump has messed around with these tariffs, and literally the last 12 hours or so, or overnight, the um, the trade war has started. We are in a trade war. Well, the US is with China. Now, you might think, well, what's the US and China got to do with us? Well, everything, because everything that you own is made in China. Everything in the States that people own is made in China. It's so wild. So, what we need to do is really just keep to controlling what we can control during these times. I think the difference with this type of economic thing that's being rolled out, it's different than the global financial crisis. So liquidity and things kind of stopped overnight. It's different to COVID because COVID was pretty much overnight, we're locked down, overnight, staying locked down. The thing with this, sure, the equity markets have had a reaction, but most people out there in, Aussie land, you're not going to feel it at all, if at all. Sure, business confidence might be reducing because, I'm a small business with all this uncertainty going on. Would I want to invest into my business? Would I want to spend money? Would I want to put on more staff? The answer is no, because business owners want certainty. So let's have a look at. Oh, we've got some questions coming in. Queen V, what happens if there is a recession? Do shares go down even further? Well, so basically, a recession. Sorry, my voice is really croaky. I've got my peppermint and licorice tea. So, if there is a recession, that's basically it means that the GDP of a country isn't growing, it's going backwards. So the question, will shares go down even further? Potentially, because if a company, or if, nationally, the country doesn't have the output to grow the GDP, that means the output is coming from potentially listed companies, and those listed companies may not grow. They may, like I said before, they might not invest for the future. So it can have some, trickle down or trickle on effects. Do you see there is sorry, what's going here? Do you see there is a downside risk with a big chunk investment as opposed to dollar cost averaging? So I think when we look at dollar cost averaging, and for those who might be new, in the spirit of me testing my tech even more, let me just, I've got a couple of other slides here and I'll get to your question. Don't tell me I didn't set it up properly. Okay, cool. So the question in relation to dollar cost averaging, here we go. Well, is my face covered by the YouTube thingy at the top? I'm gonna fix that. It's annoying. Um, let me try this. There we go. Is that better? Okay. Where are we? Get out of there. Okay. So the question was the difference between the dollar cost average and dumping one lump sum. So let's say you have $12,000 to invest into your portfolio. There's two schools of thought. The data actually, I think it's pretty complicit, or pretty compelling, the data. So you've got the option over 12 months, you will just put $1,000 a month in every single month, whatever the market's doing. Da 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 da. And then at the end of that 12 months, you've put $1,000 a month in, or your $12,000. If the unit price of the ETF or the share price was $5 here, and it ended up being $10 there, and all the variations, at the end of that 12-month period, your average buy price might be $7.20. Just making that up. Okay. So a couple of things here. Your employer contributions to superannuation, they're effectively dollar cost averaging, because every quarter or every month your employer puts money into super, you're just getting the average buy price throughout the year. So the question is it better to spread out the 12K each month, or literally just, oh, I've got 12K and just bam, dump it in there? I think you'll find most analysis and research says that this option here is more favorable. Okay. But the thing is, this is the difference between, um, you know, the what black and white says, what the textbook says, and the difference between what you can handle with your emotions. Okay. So when I used to have my financial advice business, and we would call it, clients would come in with new money. So, new money in the investment world and the financial advice world is, hey, Glenn, rocked up. I've literally just received an inheritance of $300,000 cash in my account. Okay, so that new money needs to go into the market. Now, we don't know what structure yet. Could be super, could be investing in your own name. But what we often did to kind of ease clients into it was, what did I say, 300,000 or 600,000. We would put, and I'll just go back to here, we would put half in at the start. So we would dump 300,000 in, and then over the next 6 months, we would then DCA the balance of 300K. Okay, so hope that helps. I think the main thing is long term in your financial life, any cash that you have, you really want it to be put to work. So if you look to the future, you got spare cash, you don't want it sitting in cash for the long term. So it needs to go to work over a 7-year period, because remember, we don't like to invest in equity markets or growth assets if we need the money within 5 to 7 years. So if you're saving for a wedding in 3 or 4 years, you're not saving in the stock market for that. You're just saving in cash. But if you've got a lump sum of money or inheritance, you don't need it now, you need it for the future. Over that 7 or 8 year time frame, whether you DCA'd it the first 6 months since you got it or dumped it in at the same time, you probably won't notice the difference. Okay, if you've just joined us, my name's Glenn. I host the Money, Money, Money show. Everything we talk about is general advice only. I've got a book, The Quick Start Guide to Investing. Where's that camera? There we go. If you want to learn about investing in shares, doing it the right way with strategy, there's a link in the show notes or the description below, and you can get your hands on this book. It's such a great book. And look, I just thought I may as well try and sell some books while I'm sitting here talking with you fine people. And as well, if you have just joined us, I am testing a bit of technology tonight because I plan to do a Monday night money show. Okay, Mitch, thanks. Studio looks good, GJ. Well, thank you. It's I'm sitting in a room that probably cost me $120,000. Probably more. Hope it does it sound good? That's what I want to know. Okay, let's move on. I hope that was helpful. Garav, I don't know how to pronounce your name. I'm sorry. I use Raise to manage my investments. Is there anything I should be doing at the moment aside from just waiting patiently? Well, I don't know. Anything you should be doing at the moment? Probably laying on the lounge, looking what to watch after you finish watching this. I don't think so. This all goes back to strategy with our investing. And I'm probably guilty of trying to, I'm probably guilty of not being dramatic enough with my content because I like to live in reality. So if we, for example, I'm just trying to work this out, my friends. Here we go. So the question was, I use Raise to invest. Should I be doing anything? So if this is time, excuse my handwriting, and if this is today, the 8th of April, remember 2025, we don't really want to invest if we need the money within 5 to 7 years. So let's say This is 2032. Wild, am I right? So we've come into this week, markets have gone whoopsie doo, and then I guess we don't really know what's going to happen here. But I'm going to go out on a limb. In 2023, sorry, in 2032, I would imagine uh, it probably going to be like that. And that's pretty fundamental and pretty boring. But if you weren't planning on doing anything with your raise account um, yesterday or last week or last month, if you weren't planning on digging around with the portfolio, we just keep shoveling money in no matter what the investments are going to do. I hope that helps. Let me know if I do answer one of your questions. Let me know if it has been helpful, or if you need me to clarify anything. Now, I'm just going to look for another question. Kerry, love the blue background. Well, thank you. I can change the colors. If you've looked on any of the Instagram reels, I had it red today. Natalie, should a 50-year-old still put a lump sum in super concessional if they were going to before the end of the financial year? Well, absolutely. Why wouldn't you? That's my question. Now, let me go back at the risk of being a broken record. We'll do this again because we just always need to have this perspective. If we're 50 years old today, we can't touch super until we're 60 and retired, or 65. So you can withdraw your super at age 65 regardless. And then the question is, we're 50 now, should we put a lump sum of money into super concessional before they were going to before the end of the financial year? Absolutely, because that's part of the wealth accumulation strategy of getting as much money into superannuation as we can until before the end of the financial year and until we turn age 60 or 65 and retire. So absolutely we would, because when we build our financial strategy, let's have a look again. We can't touch the money for at least 10 years. We understand that over time, investing markets will do this. Absolutely, we need to put it in. Now, the caveat is, what if we'll turn this up to 11. This will be a fun one. What if you were 60 years old today? Now, as far as I'm concerned, if you are 60 years old, and there's probably not many 60-year-olds watching this, shout out if you are, I would hypothesize that your life expectancy could be 85 plus. So we know that when we put money in our super, it does need to last until we're 85. Now, the question, or the point that I want to make is, if we had to get money into super before the end of the financial year as part of our broader strategy to get as much into super in this tax effective environment, what you can do, my friends out there in YouTube land, pretend this is our super account, and you might have a growth investment option, which could be 80% growth and 20% defensive. What you could do, you could log into your super fund and say, any new contributions that come into the super fund, put them into cash. So you still get the money into super as part of the broader strategy, but we're not putting it straight into this growth asset, which, to be fair, probably not a bad time to be investing in growth assets, given that, um, given that, you're going to need the money for at least, you know, when you retire at age 60, you don't stop living. You don't stop needing bills to be paid. You don't stop needing money, right? So the money needs to go to work, and that's why we need to be educated and just really understand the lay of the land. But in this instance, if you were 60 and you wanted to get money into super still, and there's all this stuff going around, number one, why haven't you got a financial advisor? You can go to retireright.com.au, click get help, and I'll recommend you to a retirement advisor. Or you could call your super fund, tell them any new contributions, put it in the cash option, get the money into super. All right, money's into super, or we're not investing at the moment. Let's get a plan going forward. So, yeah, I think that's the difference in my own financial strategy. I'm really, I'm kind of basic, right? I just have the view that I live on less than I earn. I'm a generous giver, and I invest the rest. Now, as part of my invest the rest strategy, that's my superannuation. It's my concessional contributions to super. It's my investing in my own name. It's my investment properties. It's all that stuff. I think the invest the rest part, it actually doesn't say my strategy. Invest the rest as long as there's no market volatility. It doesn't say invest the rest unless there's a global trade war. So we have to be very clear on our strategy. Okay, Natalie, there you go. But whoa, Natalie. Ready? Watch this. Look at me. Look at me. Look at me. Look at me. Um, I don't know if I would want the 50-year-old version of Glen putting money into the cash option and trying to time the market, because the 50-year-old version of Glen needs to invest money for the future. Not advice. Remember, anything I talk about here is of general nature. All right, I'm going to look for another question. And while I do that, I'm just going to have a drink of my cup of tea. And remember, if you want to say thank you or support anything that we're doing here and learn about investing, you can buy a copy of the Quick Start Guide to Investing. All right. Yeah, 50-year-old Glen. That's only 9 years. You behave, Mitch. All right. Let's have a look. And I'm not 41 yet. Thank you. That's in June. Okay. Let's have a look. I was thinking about a career change from government admin job to train as a financial planner. I'm a bit worried about doing that if a recession is looming. Should I hold off for a bit? Well, what I would say, number one, there is a YouTube video on this channel and a podcast episode. Um, oh, is this camera in focus? I'm just going to check the camera's in focus. Hang on one sec. I think it is, but I just want to double check. Um, there's a YouTube video and the podcast with Amy. It was only last week it went up. She moved effectively from a government role to being a financial advisor. Now, I am going to just check this camera. Just chat amongst yourselves, everyone. Buy the book. It's a good book. Buy the book. Blah, blah, blah. All right. What do we got? I think it is in focus. But I think we can't live in fear that if a recession happens, the world is going to end. I would dare say you're in a secure government job. That's cool. You can have confidence that it is probably quite secure. But what you could do as well is start to look at just researching ways that you could potentially study on the side. But I honestly don't think that if there is a recession, and all throughout like COVID, I think there was a couple of periods of like technical recessions. Most people wouldn't notice. But I would say don't live in fear. Have a plan for your life. Have a plan for your investing. And if in doubt, have a bit more cash in your emergency fund. Be a little bit more cash heavy. All right. Helen, hi. 58-year-old and watching. Follow a few of your podcasts, Facebook and Instagram. Thanks, Helen. Okay. Let's have another look here. Smiling Assassin. Pew, pew. What about using my sinking/emergency fund to buy some stocks whilst it's cheap? Yay or nay? Well, who can guess what my answer is going to be? I'm going to get up a slide. No, I don't think I do. If you weren't planning on using your emergency fund, your sinking fund, to throw it into the markets last month, I don't think we're doing it this month. And the reason why is don't try and outsmart your emergency fund, because let's do some really simple maths. And this is going to be so simple. It's going to be so simple that it could be wrong. Okay. If we had a $10,000 emergency fund, no, I'll make it 20. I'll make it 20. If we had a $20,000 emergency fund and we're like, far out, market's cheap at the moment, I'm going to take half my emergency fund of $10,000 and put it in the market. Best case scenario, yay, I timed it right. I've done 20%. Awesome. That $2,000 that you've earned on that $10,000 that you've put into the market, the issue is, number one, like, I'm not allergic to cash. I'll take it. Thank you. But the issue is that $2,000, what are you going to do now? Then are you going to take the 10 grand back off the table and put it back into your emergency fund? That $2,000, if you sell it all down, you'll have a tax event, not the end of the world. But what I'm getting at is that $2,000 that you made, or 20%, call it 40%. What if you made $4,000? It's it's great money, but it's not life-changing wow money. And what if the next week you had a legitimate emergency and you only had $10,000 and you needed the full 20,000? And then what if the market kept going down because you tried to get cute and use your emergency fund, and then you're like, crap, I need to sell those shares, and you have to pull it out at a loss anyway? Like, for me, it's a non-starter. Simple as that. So did anyone guess my answer? That's what I want to know. What course can I do to change to a financial planner course? No idea. Maybe financial planning. If you go to the FAAA website, which is the Financial Advice Association of Australia, there will be resources there about becoming a financial advisor. Okay. If you have just joined us, welcome to my test. I'm trying to grow the YouTube channel. Hopefully you've subscribed. Hopefully you've liked. Hopefully you're having a great night. I just had a peppermint tea and we're just chatting shop about what's happening with investment markets at the moment. Did that make sense, Smiling Assassin? If you're still watching, yeah, give me a love heart, everyone. If you are enjoying just hanging out, give me a love heart. Let's go. Yeah, I saw one love heart. Okay. Good. I think I've covered all the questions people wanted. I'm just having a look. Calm down, everyone. Mitch, how long were you a chair/New South Wales director? 12 months or so. DB, Thoughts on leveraged ETFs long term when there is high market volatility? I'm I'm not personally a fan of leveraged ETFs, and the reason is I just don't want the emotional roller coaster, because once you understand compounding negative returns, like, it's so wild. So if an investment drops 8%, to get back to where it was, it needs to grow from a new base 8.7%. I don't know. I don't love them myself. I don't hold any geared equity investments myself. Um, yeah, I don't know. When there's high market volatility, yeah, I'm not sure. I just don't do it myself. Bronny, I'm 65 and still working for another 8 months. Have super defined benefit. How much can I put into super from a house sale? Yeah, it was pretty poor spelling. Thanks, Bronny. Gosh, downsizer contributions. Where are my people at? 300 each, is it? I'm having a total mind blank. I shouldn't. I committed to this live webinar. I didn't get to sleep till 2 a.m. last night, and I was up at 7. And I've been pretty much in this black room all day working, because at the moment, my desk is over there until I build the offices upstairs. Um, okay, so just on the defined benefit thing, you you have to check the fund, because sometimes I will draw this, Bronny. I don't know what the fund is, but sometimes if you've got a defined benefit fund, what's a good way to draw this? Defined benefit. So there will be a portion that's defined benefit, but some of these defined benefit accounts have a little accumulation portion, which acts like a normal super fund. So number one, you'll have to ask your pension provider if they have this, because that portion there you can use it as a normal super fund. If not, you would likely set up a separate super fund and put your downsizer contribution in there. Um, so yeah, that's all good. But Bronny, if you how can I put in? Yeah, from a house sale, 300,000, isn't it? Why am I having a bloody aneurysm? Here we go. Yeah, 300,000. If you're 55 or older, you may be able to contribute. Do you ever get that like thing where you consume so much information all the time, and I do it in this money world, and I know it, but because there's so much and things change all the time, I doubt myself. It's like, did I get that right? Um, so effectively, if you I will draw this for you, Bronny. Um, so if you had a house, and we'll say that the house was worth 2 million because it's Australian property and that's all good. And you sold, and I don't know your status, but if there was, whoops, that's pretty bad, but husband and wife, so heteronormative of me. Don't at me, but whatever, at me, don't care. Um, and you sold the house for $2 million, and you're over 55, you've lived in it for over 10 years. What you can do is effectively you would buy the new house, and we'll call it 1.4 million. So you've downsized in house value. The $600,000 you can both put into your own super accounts, 300 each as a non-concessional contribution. Now, a couple of traps there for young and old players. I think you've got 90 days to make that happen, or you'll get Yeah, here we go. You make your don't you love it when he's like, "I think 90 days," and then you read it? Um, this is good because 'cause I'm learning and refreshing my own knowledge here. You've got 90 days. Now, someone in the Retire Right Facebook group the other day, get this, they put a post up, they were confused or something happened. They sold an investment property and put the money in from the downsizer, and it got stuck in there, but you can't use, the downsizer contribution for an investment property. So this is the crazy thing, guys. Like, and I know there's a few people that are maybe over 50, 55 watching this tonight. Don't be afraid to spend 5 or 6 grand for financial advice. It's a lot of money, but guess what? If you've got $2 million worth of assets, spend the 5.5 grand, spend the 7 grand, spend the 8 grand, whatever it costs for your situation. Don't spend it thinking, how are you going to invest my money? How am I going to get, 16 grand return if it costs me 7 grand or 8 grand? No, no, no. Spend that money saying, I'm spending this money so I don't F up and make a 20 or 30 or $40,000 mistake. Done. Okay. Yeah, smiling assassin, trying to get cute for sure. I did it during COVID, trying to grow my portfolio for property number 2 to pay John. Yeah, there you go. Kerry, I have some gold nuggets and have had for 19 years. Should I sell whilst the gold price is high and buy some shares rather than turn into jewelry? Yeah, if you want, do what you want. And this is why these questions, they always come up when there's like big market events. There's a big crash or a big spike. Should I do this? Should I do that? No, no, no. Were you planning to sell the gold? No. Okay, we'll keep the gold. Were you planning to sell it in about 20 years, make some money off it, and then move on with my life? If the answer is yes, well, sure, it's all-time highs for gold price. Sell it now. Um, but I think it's, yeah, I don't know. And maybe I'm guilty of not being empathetic, you know, guilty. But what do you want to do? We know one thing, gold doesn't produce an income. Sure, it's had some good capital growth, but depending how much it is worth, some questions that I'll be asking, you've had some gold nuggets. Like if you've got 100 grand in super, are the gold nuggets worth 50 grand? So then if you've got $150,000 total wealth pot, well, yeah, you're probably overweight one asset, gold at the moment. So it might be worth doing that. Alistair, with the trade wars and tariffs potentially affecting US shares, is it still a good strategy to invest in US growth shares going forward? Well, I think so, because when I invest, I'm investing for the next 7+ years. So yeah, I'm continuing to invest each month regardless of what's going on. Because I know I've been around this world long enough that things recover, things get back to normal. The world was literally ending during COVID. It was a very scary time. We all got through it. Things recovered, things got back to normal. So you just have to step back and look at the big picture. Alistair, another one. Isn't your drawing of shares going up over time historically being based off the US and free trade agreements? Not sure. Not sure. I'm not an economist. Hey, if you have joined us tonight, this is general advice only. I'm doing a bit of a tech check tonight, just chatting with a few people. I think there's about 50 of you hanging by. I'm trying to grow the YouTube channel. If you want to smash that like button, hit that subscribe button, all that crap, that would be awesome. I'm in my new studio. This is the first time that I've done a live video, so I am testing some tech. If you are new to my world and you haven't already and you want to learn about investing a little bit more, our book, there we go, The Quick Start Guide to Investing, How to Invest Simpler, Smarter, and Sooner. This book is a banger. It's so good. Not enough people have bought this. Put so much effort into this. Nick did as well. It's such a good book. I spend the biggest chapter is chapter 5, I think. 3. I will tell you. Yeah, chapter 3, page 51. Chapter 3 to. So get this. The biggest chapter in the book, that's the biggest. It probably doesn't look amazing there, but the biggest chapter in the book is the one I wrote. You're welcome, Nick. Sucked in. And it's all on strategy. It's all on strategy. Everything to do in your money life has got to do with strategy. Like, you just have to set your strategy and then go for it. And then all these little, so basically the thing is with a lot of the questions that we get during these times is they're tactical questions, but you need to be asking yourself strategy questions. The tactics, sure, you might tweak here and there, but most of our financial decisions need to be high level strategy decisions. Chantal, if that's how I pronounce your name, what app would you suggest using to start that isn't Raise? Well, I don't know if it actually matters. I can't give personal advice, but some little apps out there, the Sharesies app, they've paid to advertise on this podcast before. Superhero app, did they pay? Maybe they paid once. I'll take any money. I like money. Beta Shares Direct, that's a new app. Now, the thing is, I'm a big believer in not using, and this is going to freak everyone out, not using a traditional broker. I like to use a platform. I like to have everything taken care of accounting wise at the end of the year. And I just want my life to be easy. So it really doesn't matter. It's more important what you invest in as opposed to how you invest. So I hope that helps. Jessica, I was going to switch super fund, but now I'm concerned that it's not the right time. Any comments in early 30s? Thanks, Glen. Well, thanks, Jessica. I did a reel today on Instagram about switching super. The question is, I will draw this because it might be helpful. We know we want to, let me set this up. We know in theory, when it comes to investing, and Jessica, check out the reel that I did. It's got like super written on it. We know in theory, we buy when things are low and sell when things are high. That's how you make money. It's called a spread. Okay. So if you had a super fund that was 100% cash only, and you wanted to move it to a super fund that maybe had, we'll call it 80% growth assets, and you wanted to move it to there, it would make sense to move the super up in terms of risk when markets are down. Okay. So the question is, are you in? Well, we'll just do it the other way. If you had 100% of your super in growth assets at the moment, well, we wouldn't want to move to cash because we've locked in we've just locked in the losses. So when markets are uh, going up, it's okay to switch um, up in risk profile. But I think that's right. It's been a long life. But if markets are going down like they are now, well, we don't want to switch down because we'll lock in our losses. But the reason why I don't mind someone switching up in terms of investment option profile on risk, because relatively to where we've come from, markets are down, so it's okay to make that change. Does that make sense? Okay, Jessica said growth asset to growth asset. Yeah, okay, that's cool. Let's talk. Um, I will draw this again, Jessica. Should have just looked at what you said before I started chatting for 20 years about something. Um, Look, if this is the market and you had a a uh, a like for like asset, because you're buying and selling in the same market, it probably doesn't matter, if that makes sense. So if you switch from high growth to high growth at a bit of a peak, you you're still buying into the market at that growth. Likewise, if you do it when there's a bit of a correction, the one thing you need to consider, and it's not a huge deal, have a look in your super funds, and this is a little hidden fee that's in PDFs, PDSs. Ugh, fading. It's called the buy sell spread. Might be 0.2% or something like that. So what they do is every time you sell or buy units, the spread, the fund or the manager will take a very small percentage. I mean, not a showstopper, but yeah, I'm not too stressed about moving in the same markets. You just like don't move, don't get cute and be like, all right, I've got this growth investment now. I'm going to switch to a new fund. I'm just going to leave it in cash for a while. Then I'll wait 3 months and see what happens and then put that into growth. Just switch it. Also, read that. Would you increase the cash portion though with recent events by not selling but through savings? Would you increase the cash position through though with recent events? Thanks, Jessica. Or do you prefer Jess? I appreciate your work. What by not selling but through saving? Well, okay, so basically that's kind of what I said earlier, where you might be getting ready to, retire, and you might be age 60 and you want to retire at age 65 and you're age 60 now, and your super is in an 80% growth and 20% defensive, and you've worked with your advisor and we still want to put a heap of money in, but effectively we're just putting cash into our super account into the cash option over time, and what that will do is slowly dilute the defensive portion. So yeah, that is a reasonable strategy. What's your reason for switching? Have you considered implications on your insurances? Okay, so with your super fund, if this is your super, and we'll just call it XYZ super fund, and in the super fund, you have your 80/20 investment growth, and you've got some insurance. That's how most people have their super set up. When it comes to insurance, if you are moving funds, as soon as you take that money out of this super fund, they will cancel your insurance. What you, I think, need to do, and that's what we call best practice, and what I would suggest anyone do, is set up your insurances separate in its own shell of a company, and you can speak to Sky Wealth. I'll actually put a link, sky.com.au. I'll just put this in the chat for anyone who wants to just chat with them. That website there, they sponsor our podcast. You get them to set up an insurance policy that's with an insurer. They've got a variety of insurance companies. It's still considered super, but the premiums are funded from your accumulation funds, not the internal super fund insurances. So if you then move to, ABC Super, move to their 80/20, you would just tell this insurance company now to take the money from the new super fund and not take it from the old. So your insurance is effectively portable, forevermore, amen, and all that stuff. All right. Yes, I'm talking about life insurance and TBD insurance. So one of the reasons Bronny, yeah, it's Bronny. One of the reasons that you do want your life insurance, and we'll call it death cover, paid by your super fund. So again, we'll say that this is our 80/20 portfolio. Now, this is Glenny, and he's awesome. Hi. Now, ordinarily, if Glenny went to the TV, and this is the TV, it's an old school TV with an antenna and dials, and there was a crappy add-on during the morning show selling some crappy life insurance, okay? And Glenny went, "Oh, yes, I want $1 million worth of death cover. Gimme, gimme, gimme. I get the cover. Here's my bank account, and I pay for that insurance out of my bank account." Okay? Awesome. If Glenny dies, that $1 million is paid to my estate or beneficiaries. Awesome. If I died, there's also money in my super account, and gather around, children. Superannuation does not form part of your estate. You need to elect where you want your super to go when you check out. It's not an estate asset. I've elected that I want my super to be paid to the estate or my beneficiaries. That's all well and good. So I've died. My $1 million insurance policy that was sold to me on daytime TV, anything sold to you on daytime TV is rubbish. There, I said it. And did that work? I was trying to be cool. Let me try that again. Anything that is sold to you on daytime TV is rubbish. It gets paid to the estate. The reason why you want your death cover put and paid for in your super fund is a couple of reasons. Number one, and you can go to Sky Wealth and get them to set up a policy, $1 million death policy funded by your super. First and foremost, it's a better policy than this rubbish that's on TV. Straight up. Oh, sorry. They've set this policy up here, funded by super. Yeah, so it's better than the policy on TV. Okay. Then number two, it's often, and this is so crazy, cheaper than the crap that you see on TV. It's often cheaper than the stuff that's in your super fund. Even though the financial advisors are getting paid from the insurance company, not out of your pocket as a commission, it is still cheaper than most super funds and the crap on TV and is better quality. But here is the kicker, ladies and gents. Here is thy kicker. When your super fund pays for this $1 million life insurance, the super fund claims the premium on tax, 15% super fund tax. The net cost to you, instead of $1,000 that I'm paying for this crap on TV, it's $850. Number one, you've automatically made your death cover in Australia tax deductible. It's not tax deductible in your own name. It is to the super fund. Number two, in Australia, there is no tax on death proceeds. So the $1 million can still go to your estate or to your beneficiaries. You can tell this is becoming a spaghetti pie, whatever. You can tell the super fund to send the super to your spouse, and tell this insurance policy to send 50% to your spouse and 50% to your kids. So you've got complete control. Better policies, cheaper, tax deductible, more estate planning control. If I don't rest my case, not sure what I will do. That's a great explanation of insurances. I like the drawings. Thanks, Alistair. Chantel, should we put the election for super in our will anyway? I've read some horror stories. Yeah, I mean, I don't have a spousal partner. I don't have kids. There's a binding beneficiary on my life insurance in super that is to my estate. So the super trustee, because it's a policy in super, will just go, yeah, we have to pay this to Glenny's estate. Okay, a couple more questions and I'm going home. I'm only doing an hour tonight or I'll get carried away. Hey, just remember it's general financial advice only. Just remember, if you haven't bought the book, have you found the link and ordered one tonight? Okay. If you sincerely buy one of the books, right, and you read it, and you're like, you know what, Glenn? I did not get my $22 worth. Please email me. Please email me. I would love to know that if you pay $22 for this and you find you got no value out of it, please let me know. All right. 2 final questions to go. Natalie, she's back. Question about diversification in ETFs. I get the point of it, but why even invest in ASX? I'm assuming people from other countries don't. No, there's well, thanks for buying 3. No, borrowing from the library doesn't count. You should buy a copy and gift it to someone. Ooh, 10 out of 10 recommend the book. Yeah, look, the ASX, there's some great companies in Australia. The ASX has done very well over, the last inception, right? Yeah, there's plenty of other countries invest because it's part of the world index. So yeah, I think that's fine to do. Imogen, hi. I'm 20, female, am great at saving but looking to invest. Awesome. What are the pros/cons to adding existing super or independent non-super or both? Should I be looking to take advantage of the current markets? Let me just reread that question while people buy some more books. I'm great at saving but looking to invest. Awesome. What are the pros and cons to add existing to super Oh, or independent, non-super, or both. Should I be looking to take advantage? Okay, cool, 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 cool. Look, you are okay. My thing stopped working. That's great, isn't it? Oh, press the wrong button. User error. Okay, great question. Look, 20 years old, great at saving. I think you just need to be aware if you were to put money into your super that you literally can't touch it till you're at least 60, like 40 years. Now, Imogen, when she's 60, is going to thank 20-year-old Imogen. So what I'm probably thinking at the moment is read this, Imogen, when I talk about your question. I honestly think I'm probably and I'm just going to make a number up. If I had, let me do this. If I, sorry guys, I'm just going to make a big number up. If I had $1,000 to invest each month, because you're a good saver and all that, I'm probably just putting some type of framework in my life that, because if you are working full time, you're going to have 12% going to super anyway. I'm probably saying in my financial life, given that you're 20, I'm doing 80% of my investing outside of super and maybe only salary sacrificing 20%. There, I said it. Read that. Because it's all well and good that you are a good saver. Awesome. It's all well and good that you want to consider super. Awesome. I love that. But I just want you to have as much flexibility and options in your financial life. So that's kind of what I'm thinking. Oh, thanks for ordering the audiobook, Alistair. And if you are still watching Imogen, does that make sense? So, look, I think I'm going to leave it there. I really appreciate those who have joined me tonight. I really appreciate everyone who has purchased a copy of this book. It's a banger. It will change your life if you let it. There is an audiobook everywhere you get it. There's a link in the thing below. Yeah, thanks, Imogen. I just really want you to not. I mean, okay, so let's play this out the other way. If you were like, okay, I'm really good. I've got $1,000 a month. I'm going to put 50% in super and 50% out. Remember, you can use the First Home Super Saver Scheme. Now, it just means any extra money that you do put into super, if you wanted to buy your first home later, you can access that. So that that could help. But yeah, the good thing is you've got options. When you're a good saver, you can't wreck it, right? You just really need to know that we lie in the bed we make for ourselves. And what a good problem to have. Oh, I've been shoveling $500 a month into super. Oh, crap. I want to go to Prague now and spend a year overseas. I need cash. All right, well, I'm doing that in 4 months or 5 months or a year. You can always just go, okay, I'm just going to stop putting money into super and I'm going to stop my investing and just save cash for this period of time. You've got plenty of options. So yeah, it's a really good discussion there. So all right, well, thank you everyone for jumping on, letting me test this studio. I do want to have a look at doing a Monday night show. I know everyone's probably just dropped in here, but what has everyone thought of the hour? If you can maybe just put some, just give me some live real time feedback. in the chat. Good or bad, I really don't mind. You didn't pay for it. If you said it sucked, shame on you for spending an hour here. Just yeah, let me know any initial comments, thoughts on me, the topics, the presentation, the tech, anything like that. Here to learn. I do look a bit tired. I'm rooted. I said before I was up at I went to bed at 2 a.m. and woke up at 7, and I've been working nonstop all day, but I still wanted to do this tonight. So I've now been at the studio for over 12 hours. So I think I need to go home. I didn't great, but you didn't answer my question. All right, stuff ya. Well, I'm gonna uh a deep 9. I'm gonna answer it to spite you. Scrolling up. Have been thinking about investing amounts with some leftover weekly spend money. How much is too little and not worth it? Well, the good thing is, um, micro investing apps like your Perla Micro, like your Raise, like your Sharesies, you can invest for $5 from like $5. So any amount that you invest is a good amount IMO. And remember, read that. So cool. All right, there you go. You need someone to screen yeah, I know. I do. I really do. But it's obviously not making any money doing this, but yeah, I do. I need to work out something, whether I get a bit of a moderator or something. And maybe, hey, if you live in Newcastle and you want to come and help on a Monday night, come down to the studio and you can help put the show together. Oh, thank you so much, Imogen. Tell your dad I said hi. Yeah, that's great. All right, friends. You're being real. I've been Glen. Good night.